What's up, everybody? Welcome back to Brofolio. Wages are now growing slower than inflation for the first time in 3 years. April CPI just printed the hottest headline number since May of 2023. The US bond market is right back at the levels that triggered the 90-day tariff pause last year. And both Japan's and the UK are at the highest yields this century. This was not a normal Tuesday. Let's break it all down. First on the clock, CPI. Both core and headline numbers came in one tick above their expected forecast. The hottest headline number since May of 2023. These numbers should make every Fed watcher sit up, as now the odds of Fed rate hikes are surging. And yes, you heard that right. Not a pause, potential hikes. Now here's the part most of the headlines are missing. Over the same 12 months, wages grew 3.6% and CPI only grew 3.8%. Inflation just lapped your paycheck for the first time in about 3 years. Americans are under growing financial pressure. This is the kitchen table version of stagflation. You get a raise on paper, you lose ground in the grocery store, and it's just now starting to show up in the data. This print also marked a 62 consecutive month streak where CPI printed over the Fed's 2% target. 62! The Fed has not hit its own goalpost since March of 2021. There is no version of transitory that lasts 5 years and 2 months. And realistically, the basket is uglier than the headline. Fuel oil is up 54% year over year. Gasoline is up 28%. Electricity is up 6%. Transportation is up 4%. And apparel is up 4% as well. This will play out to be more than just a wage and inflation problem this year. We will feel the ripple of these numbers for years to come. Now let's recap the US indexes. All 4 major indexes opened red on the CPI print. The Nasdaq was down over 2% intraday. And then they spent the rest of the day clawing back. By the close, the Dow finished basically flat. S&P 500 closed slightly red, finishing only down 0.15%. The Nasdaq closed down 0.70%, and the Russell 2000 got hit the hardest, closing down about 1%. Pretty crazy recovery today, right? Let's look closer. Money was rotating today, hard. Health services was the day's big winner, up over 2.75% as a sector. Health technology, consumer non-durables, and energy all caught a bid as well. That is the textbook inflation rotation. Out of growth, into hedges. And then look at who got dumped. Tech finished down 1%, and chips got crushed, finishing down 3%. Qualcomm finished down 11.5%, its worst session since 2020. Hims and Hers crashed 14% on an earnings miss. On the green side, Merck up 1%, Walmart up 2%, Johnson & Johnson up over 1.2%. Defensives, pharma, and the grocery store. This is exactly what an inflation rotation looks like in real time. The fast money sold semis and anything that needs cheap money to work. They bought oil, they bought groceries, and they bought drug companies. This isn't capitulation, this is a positioning shift. And historically, this kind of shift starts about 4 to 8 weeks before the broader index notices. So why is oil and certain commodities ripping today? Iran came out today and warned that if the US or Israel strike again, they will enrich uranium to 90% purity. 90% is weapons grade. That is not a forum post, that is a major threat towards the US. Speaking on the US, the Strategic Petroleum Reserve is being drained again. 4th exchange operation since the start of the war. Department of Energy offered 92.5 million barrels, but only 53.3 million were awarded. Major US oil companies lined up to take the barrels. These leases usually see a 24% premium attached to them, which means these companies defiantly think oil is going higher. And JP Morgan see it that way too. They believe the base case envisions the Strait of Hormuz reopens in June, anchored on the accelerating pace of oil inventory depletion. Read that twice. JP Morgan base case is that the world runs out of crude onshore before the strait reopens, and ultimately forcing an agreement by both sides to ratify it. That is a hard physical deadline showing up in a Wall Street outlook, and they suggest that oil prices should remain in the low 100s for the rest of this year. And then there is copper. Copper printed a fresh record today, up 40% in 12 months and up 75% since October of 2023. But the driver isn't Iran or inflation, it's the data centers. Every gigawatt of AI compute needs copper in the walls. And the AI build-out has a lot of commodities, Bill, and they are all coming due. Staying with AI, Morgan Stanley updated the hyperscaler CapEx curve today. Estimates have increased to $805 billion on AI CapEx in 2026 and $1.1 trillion in 2027. This will represent 3.3% of GDP and will exceed what the US spends on national defense. And AI build-out ideas are starting to get wild. Per the Wall Street Journal, Google and SpaceX are in talks to launch data centers into orbit. Yeah, orbit. Because the power grid down here can't keep up with the build. Only time will tell if this is only pre-IPO hype or actual possibility in the near future. Now let's look at Sam Altman. Altman is testified today at the Musk OpenAI trial. On top of that, the House Oversight Committee opened a probe into his personal investments. 6 Republican state attorneys general just asked the SEC to review OpenAI's governance before any IPO moves forward. The specific deal in the spotlight is Helion, the fusion startup Altman personally invested in, the one OpenAI is now buying power from. And this company isn't the only conflict of interest. Moving to Anthropic's, their board just declared every unauthorized share transfer, including all those tokenized pre-IPO products, void, not recognized on the cap table. The implied valuations on those platforms got torched overnight. We are starting to trouble underneath the hood of the 2 largest AI companies, and they are still yet to even become public. Going to the international market. The Kospi, Korea's main index, had a wild round trip today. They touched 8,000 for the first time ever right out of the gate, then plunged 5.1% intraday and closed down 2.3%. Why? A senior policy advisor to the president floated something called a citizen dividend, funded by an AI windfall tax. Markets read it as a chip export tax on Samsung and SK Hynix. Panicked first. It all calmed down later when the advisor clarified he meant excess tax revenue, not a new levy on profits. But the round trip is the tell. 8,000 was a top for now, and volatility is in the air. India is still bleeding from Prime Minister Modi's speech for austerity over the weekend. Emerging market panic don't reverse in a day, and it usually telegraphs what's coming for the US 2 to 4 weeks out. Japan's 10-year yield closed at 2.54% today. Highest level since 1997. That's nearly 30 years. This is the country that ran zero rates for an entire generation, and the Bank of Japan is feeling the pain and getting repriced in real time. The UK 30-year gilt closed at 5.8%, highest level since 1998. Same week the Prime Minister is fighting for his job. Flipping over to US yields, the 30-year is bumping the 5% line again. 10-year is pushing toward 4.5%. 3 of the 4 biggest sovereign bond markets in the world all hitting decade or longer yield highs on the same day. That is not a coincidence. That is the bond market, the actual smart money, saying out loud that they will not buy duration at these prices anymore. Tomorrow morning, the catalyst is PPI. With CPI being hot, PPI tells us whether more inflation is in the pipe. Anything above 0.5 month over month and bonds will get hit again. After the close, we get Cisco, big read on AI networking demand. Same evening, Alibaba and Tencent, 2 of the biggest reads we get on the Chinese consumer and the China side of the AI build. And in the background, Sam Altman is on the stand. Any rhetoric out of that courtroom could move AI sentiment overnight. Now I want to leave you with this. Episode 1, we talked about the rhyme, 1999, mega caps carrying the index, Main Street pinched. Today's tape just added a verse. The bond market, the smart money, just repriced sovereign risk in 3 currencies on the same day. Inflation is now running ahead of wages. The Fed's 2% target is 62 months gone. And CapEx is so vertical, the only place left to put data centers is in orbit. I'm not telling you to sell. I'm not telling you to panic. I'm telling you to pay attention to the bond market. The bond market gets the joke first. That's it for the second official Brofolio. Thank you for watching. If you got any value, please like, subscribe, and drop a comment. See you tomorrow.